This program is brought to you by the Practicing Law Institute, a nonprofit learning organization dedicated to keeping attorneys, professionals, and accountants at the forefront of knowledge and expertise.
Hello and welcome to the inSecurities podcast, keeping it fresh and staying wonky on the latest securities, regulatory, and enforcement developments with a practitioner's perspective on the stories you should be following. As always, I'm Chris Ekimoff, and I'm here with my co-host, Kurt Wolf.
It is very good to be with you again, Chris. You know, episode 125, it's sort of a benchmark. And I think in the past, we've tried to mark these signposts along the way by having some good guests on the show.
That's right.
And very excited with the guest that we have joining us today. Now, let me just take you back, because I think we've been fortunate to have on the show 4 of 5 sitting SEC commissioners.
Yeah, that's right.
Commissioner Peirce, Crenshaw, Lizarga, Ueda. There is one member of the current commission who hasn't yet dropped by our virtual recording studio. So I'm very excited to say that SEC Chair Gary Gensler has graciously agreed to join us here on the show today to talk about a number of important SEC regulatory and enforcement topics and a little bit about the current SEC rulemaking agenda. Chris, are you excited for this one?
It's a great way to mark episode 125. I'm excited just to get into some of the details. A lot of these issues we talk about generally, it's almost like we're going to the source to a certain degree to hear straight from the chair the topics and the focus that we'll have both on the podcast today and in some of the weeks and months to come.
Yeah, absolutely. Now, our regular listeners will undoubtedly know a great deal about the chair, but for any newcomers, and if we get some clicks that we don't ordinarily get, Chris, why don't you give us a quick little rundown on Chair Gensler's background and experience?
Gary Gensler was sworn into office as chair of the United States Securities and Exchange Commission on April 17th of 2021. Before joining the SEC, Chair Gensler was professor of the practice of global economics and management at the MIT Sloan School of Management, co-director of MIT's FinTech at CSAIL, and senior advisor to the MIT Media Lab Digital Currency Initiative. From 2017 to 2019, he served as chair of the Maryland Financial Consumer Protection Commission.
Chair Gensler also formerly served as chair of the U.S. Commodity Futures Trading Commission, leading the Obama administration's reform of the $400 trillion swaps market. He also was senior advisor to U.S. Senator Paul Sarbanes in writing the Sarbanes-Oxley Act of 2002, and was Undersecretary of the Treasury for Domestic Finance and Assistant Secretary of the Treasury. Prior to his public service, Chair Gensler worked at Goldman Sachs, where he became a partner in the Mergers and Acquisition Department, headed the firm's media group, led fixed income and currency trading in Asia, and was co-head of finance, responsible for the firm's worldwide controllers and treasury efforts. Chair Gensler, that is a long wind-up, but we are indeed very excited to have you on the show. Thank you so much for joining us.
I'm so excited. I'm just kind of wondering who was the 124th podcast with?
It was with a strategic consultant, Eric Hotmeyer of Watermark consulting firm. He talked a little bit about how some of the regulated entities or some of the folks who are being investigated by your Division of Enforcement might think about engaging with key stakeholders like folks at the commission, like folks on the Hill, to try to maybe change the narrative about what's going on.
I see. Well, I'm honored to be with you. I'm looking forward to a lively conversation. The Securities and Exchange Commission, it's a great agency. We recently celebrated our 90th birthday.
Yes.
June 6, 1934. And though technology, business models, the global economy has changed quite a bit in 90 years for sure, kind of the core of what we're about has stayed the same. It's about building trust in our capital markets. And Roosevelt understood that without doing that, without, I would even say, restoring trust in our capital markets at the time, the economy couldn't get out of the ditch that they found themselves in the 1930s. I was just so proud to be part of this agency because I think over those 90 years, we've done a tremendous amount to protect investors. As William O. Douglas, our third chair said, he went on to be on the Supreme Court, but he said, we're the investor's advocate, but also to facilitate capital formation. So it's about those investors and issuers, and then making sure the markets in the middle work for investors and issuers. And it's kind of not the other way around. It's not that investors and issuers are there just to be customers of the market in the middle, and the markets are the primacy. The primacy really here, and the whole architecture is building trust in our capital system through disclosure, through rules that protect against fraud and manipulation, making sure advisors and broker-dealers keep their customers ahead of themselves. And really, I truly think these 90 years have helped not only investors and issuers, but lifted up our economic success as a nation. But you've got questions. Over to you.
Chair Gensler, I personally always appreciate how you kind of draw those through lines, sort of talking about what's happening today in the context of things that have come before. I will say one thing.
Partly, Kurt, because human nature doesn't necessarily change, even if technology and business models so rapidly change. And finance itself, even since antiquity, well before we were a great nation, tends towards certain features. And so it's really trying to understand why our predecessors did what they did, why policymakers made the choices that they did, and then how we can effectuate, again, our core mission of protecting investors and facilitating that issuers can tap the markets.
I think as a policymaker, one thing that's different is the way that you can communicate, with the world, with regulated persons, with regulated entities. And
I don't think William O. Douglas did podcasts.
Right, exactly. And I think it's a feature of your time as chair of the commission is your efforts to really, I think, reach out to say things publicly, whether that's through your account on X, formerly Twitter, the office hours that you post on SEC's YouTube channel. You've been on The Problem with Jon Stewart. You've been on Preet Bharara's podcast, right? So I do think you make a concerted effort to engage with the public in ways that maybe your predecessors haven't or couldn't. But it seems very intentional to me. So I'd love to know a little bit about the thinking there. Why is that important to you?
Well, I think it's very important for a number of reasons. One, I deeply believe in our democracy and our constitutional system, but it's how do we communicate to the American public what we are doing so that they can actually understand what their government, and it's their government, it's 330 million Americans' government, what we're doing on their behalf. So I think that's a really critical thing. Two, it's about investor education as well. In the capital markets, we have something like 115 million households are invested in the mutual funds or registered investment funds. We have, I think, 58% of American households are in the stock market in one way or the other. So it's really also, secondly, about investor education. And thirdly, which is sort of a corollary of the first two, but I think it's also important, thirdly, in public policy, that we allow different views come together and we debate these different views. And so it's how we communicate and we debate in the public square, so to speak. You mentioned my predecessors. I mean, there are many predecessors. I'm the 33rd chair who understood how to communicate to the American public. I mean, even Joseph Kennedy, the very first chair, who was father of and Jack Kennedy and Bobby Kennedy and Teddy Kennedy, the three senators and one president, and so forth. He always brought the press right into his office. And there's this great picture of him with his sleeves rolled up and the press all in and kind of communicating with them. Arthur Levitt in the 1990s, I mean, really understood how to communicate and engage with the public through the media and so forth. So I think that's been true, but the technologies have changed. And I felt, working with the team, we should meet the American public where they are. Mm-hmm. And so thus social media, and yes, some of these short videos, these 3 or minute or so videos, to just really break it down and explain what we're doing, why we're doing it, and the relevance to their everyday lives.
I think that's an important thing to touch on. The fact gets thrown around often that I believe it's a couple of years ago now that YouTube is the most consumed medium if you look at the American populace as a whole compared to your traditional media outlets through cable television or network news. Now, Chair Gensler, you've been at it for 3 years, doing a lot of the appearances and discussions Kurt mentioned through YouTube, through X. Anything really stick out in your mind as a great interaction, a great public appearance that you made, and maybe one that's a little bit more fun or funny than some of the others?
Well, this is still live, so I don't know how to rate this one right.
We'll ask you in a couple of weeks what you thought, but for now.
Just below Jon Stewart, I would
I'm
imagine,
sure.
but we'll take second place.
You and John. Look, it's always wonderful to be in a live studio. There's something about being on set, like on the set of the New York Stock Exchange there, and sitting there, and I've done it on set a lot over the years. I've been at this for 25 years or so in the public policy space, and it's a huge honor. I can't believe it. I pinch myself how privileged I am to be serving and trying to do the work of the American public. But I would say, you mentioned Jon Stewart. Certainly, I've done 2 interviews with John, and he's sharp, he's quick, he's got a certain snark, if I can say that. But he does his research. Look, a lot of journalists do. I've enjoyed doing sometimes I've done work like Dave Lauer has pulled together a whole bunch of folks on the internet. And so it's live with not just thousands, but tens of thousands of people and taking questions live. And I do remember one time Commissioner Crenshaw and I did something for Current Military. And it was just a fabulous time where I don't know how many, whether it was 500 or multiple thousands of current military on the line, and we were taking questions, and it was an open mic session. And I really like that. I really like look, it's great being at these industry conferences too, and the trade associations. But when given the opportunity to talk live with, everyday investors or folks in the military serving our great nation, but thinking about how to save for the future, I've enjoyed that. So it ranges, and we'll later in a few weeks decide where you fit in that range.
Fair enough.
Hopefully within the bell curve, maybe not at either tail end, but
you're not quite like Jim Cramer yet.
I think that's a good
we'll
thing.
Just say, we'll just take that
don't
as
answer
it is.
that. Yeah.
Listen, he's been doing this for over 20 years. I first was on Jim's show when it was Kudlow and Kramer. And he had my identical twin brother and me on in 2002. So
that's cool.
Many years at it. And Chair Gensler, we often look at that public engagement. You spoke a little bit about awareness and education and meeting the American people where they are. To me, it almost speaks to maybe a discussion of public trust in terms of engendering that trust or reaching out to those folks. Since becoming the chair, that's a theme that's really run through many of your speeches and remarks. That idea that maybe the erosion of public trust that has developed over the past few years or decades. We've talked a little bit about your penchant to look back at the history of the commission and where we see today. In fact, at the SEC Speaks conference a few weeks ago, you noted that, quote, the 1920s was a time when markets were rife with fraud and manipulation. This led to a fundamental breakdown of trust in capital markets, end quote. Your remarks went on to talk about the SEC's important role in restoring that trust and promoting efficiency and competition in the markets. Kurt, a few episodes ago, we had a great conversation with author Diana Henriquez, who wrote a book about the formation of the SEC, and we really got into a lot of those topics. But Chair Gensler, I'm interested with that reflection, where you see maybe that public trust breaking down in the markets today and how the SEC is combating that.
Look, I think that trust is at the core of finance. One even has to, you have to trust your bank. If you put money in a bank and you take back what's called a deposit, right? But what Roosevelt understood was that you wouldn't restore trust if the issuers, the people that are offering or selling securities to the market, didn't give what Roosevelt called complete information. He called the 33 Act the Truth in Securities Act. A little better than your title, inSecurities podcast. Like you guys are you're the antitrust. I don't know how else to say.
Might be
insecurity. Like you want to get under people's skin. No, Roosevelt wanted to go the opposite of what you guys are doing, and he wanted the Truth in Securities Act. And so now you're asking about where are we in the 2020s? I think that, look, we've got the deepest, most liquid capital markets in the world. We're a little over 40% of the world's capital markets. To put it in size, it's about 110, 120 trillion dollars in our capital markets. Little less than half of that's the stock market. And the rest is, sort of other fixed income and other markets. So we're doing something right for sure. We're only 22 or 3% of the world's economy. So we punch above our weight class because we're the deepest, most liquid. People want to come to our capital markets. But at the same time, it's how we update our rules to instill greater trust. So let me just think through a couple things here. Like there's the trust in the financials themselves. Like my grandfather, who I didn't know, Ellis Tillis, my mom's dad, used to say, figures don't lie, but liars sure can figure. And so it's like it's this core thing. It's like, how do we ensure for the trust in the financials themselves? And I was honored to work with Paul Sarbanes some 20-some years ago, 22 years ago, on that thing called Sarbanes-Oxley. People were cooking the books, and we had those big bankruptcies at Enron and WorldCom and others. Well, now 22 years later, looking at the Public Company Accounting Oversight Board under Chair Williams and that board's leadership, they've come together and they're actually updating the standards for auditing, many of which go back 50 and 60 years and have not been updated in 50 or 60 years. So how do we instill trust in the financials? We've certainly brought and used our enforcement authority where appropriate, following the facts and the law with regard to gatekeepers. And those gatekeepers are the auditors and how they're conducting themselves in the markets. We've done things around trust also for corporate executives. And one key thing is if the numbers are wrong, do they keep their compensation? And so we updated rules around clawbacks that went and got adopted last year, but also about how corporate executives can sell their shares in the market. Your listeners will know this around a rule called 10b5-1 plans. Yep. But getting rid of the jargon, it was basically insiders often have material non-public information, and should they be able to sell their stocks in that, sort of circumstance? And so we sort of put a pause in. You have to put a plan in place and wait at least until the next quarterly results, 90 days later, and sell that stock. So we've done a lot of things around rulemaking to instill better trust in the markets. But I would say this, and I'm sure you'll be asking later, there's a part of the securities market which is crypto securities. And I'm not trying to prejudge any one crypto, but this is an area that's rife with fraud and bad actors, in part because there's a bunch of actors, again, without prejudging any one of the firms, that are not complying with these time-tested rules around disclosure and protection against conflicts of interest and so forth. And so that part of the securities market, which is small in relation to the 110 trillion capital market, but still that part of the market could undermine trust in our overall capital markets because a small corner of the market is not complying with standards, right. But more importantly, that corner of the market is not giving people the proper disclosure. It's rife with conflicts. There's been far too many bankruptcies. And you look at that field and you say, the leading lights 2 years ago, where are they? They're in jail. They're awaiting jail. They're awaiting extradition. And so that is on my mind. That corner, again, it's relatively a small corner of the overall securities markets, not undermine confidence in our markets.
Yeah, well, we certainly do want to talk a little bit about crypto, so we'll circle back to it if that's okay with you, Chair.
And did you have any reaction to this insecurity thing that you've?
Well, I mean, so my reaction is we actually don't try to get under people's skin, as you say. That wasn't the intention. Although
I did get the name right. You're the Securities.
Yeah. I think maybe there were a couple things that went into that. One, I mean, it's catchy.
I mean, I guess, it says something about Kurt, you and Chris.
Yeah, I think we're less insecure about it than we used to be, but many of our listeners, I think, are maybe insecure about how the markets work or what the role of enforcement might be. And
Look, I would say this, markets have risk. That is the fundamental nature of finance.
Mhm.
And maybe it's what draws a lot of people to the market. You could hold risk and get a return for it, but also risk being risk, or as Secretary Rubin used to say, and I knew Bob, and he was a great secretary of the Treasury and great leader of Goldman Sachs, but he said, markets go up, markets go down.
Mhm.
But back to your question.
Yeah. Well, what I was going to say is we don't mean to get under anyone's skin, although I may be skating close to the edge here. Look, sometimes folks come on the podcast here, and while you've done a lot of great things to build trust in our capital markets, sometimes our guests will note that market participants, regulated persons or entities have a sense that they're losing trust in the SEC, in the commission itself. And what they often say is that they feel like the SEC is stretching, whether that's through rulemaking or enforcement, to reach new areas or imposing overlapping regulatory compliance requirements or costs that they maybe see as exceeding the benefits of the burden that they're required to undertake. I'm sure this isn't news to you, right? I guess the question is, how do you respond to that criticism?
I'd say this, Kurt. We have a role on behalf of 330 million Americans. It's naturally a different role than any one of those other parties that you're speaking with. Market participants have a role to frankly build their business, maximize their revenues and profits for their shareholders, serve their customers for sure, serve the investors, but they have a role to play, which is far different than ours. And there's a public good, and this is an economic concept, but there's a public good from these disclosure regimes. There is a public good from having standards on how securities trade in our secondary market. There is a very real public good having a fiduciary standard, not without some costs. There are certain costs. We just moved from settlement cycles of T+2 to T+1. So here's the public good. If you sell your securities on a Monday, guess what? You get your cash on a Tuesday. You don't have to wait till Wednesday any longer. That's really good. But nobody would tell you there weren't costs for thousands of institutions, investment advisors, broker-dealers, and the like, to actually navigate that. The clearinghouses, the custodians, the transfer agents, the FX traders, foreign currency traders. And we did it in Canada. We did it in the US. We did it in Mexico. Now, others did it in Mexico, of course, Argentina, and Jamaica. That was good for the public. And so now to your question, a little bit like there's going to be naturally times that people disagree with us. We need to hear those comments. We welcome those comments. We put out all of our rulemaking, we put out to notice and comment. We get a lot of feedback. Sometimes we adjust. In fact, we very often adjust the final rules from the proposals. And sometimes we reopen them or we repropose them. And we're considering that on a number of consequential rules right now to repropose. And so that give and take and learning from the public is really critical to us. But I would say this, our client is the American public, and some of those market intermediaries in the middle, their clients, they might say, well, that's the American public as well. But ultimately, they have a fiduciary duty to their own shareholders to maximize their revenues and profits. And so therefore, you're going to have some difference of points of view. Also, we're human. We're going to have different points of view. And our role at the SEC is to listen to all that incoming and do things within the law, how the courts interpret the law based on the economics, based on the public feedback, with an eye to those investors and issuers in the American public.
Yeah, that makes a lot of sense. And it's no surprise to me that you sort of welcome the dialogue. And I know.
And I would say this more, Kurt, if you look at my call sheets are made public after a couple of months, they're all put out publicly and so forth. So it goes beyond the 35,000 or 50,000 comments, or I don't even know how many comments we've got, 50 to 100,000 comments probably on all these proposals. We take meetings
Yeah.
for months on end about these things. Staff does as well as I do. And so that engagement benefits the process. I would say, by the way, with regard to enforcement, it's an important tool of the agency. And this was part of the architecture all the way from the 1930s. I want to say this for some of the securities lawyers listening. Think about insider trading, a simple concept. The people inside of an issuer shouldn't trade on that material, non public information. They shouldn't have some advantage. And this instills trust in the market, but it's also about important theories around misappropriation of that information. Well, until the 1960s, that wasn't necessarily the case. And there were important cases that sort of narrowed the SEC's remit. And under Chair Manny Cohen, and then Johnson appointee to be chair, and then Irv Pollock and others who ran the enforcement division and everything, they started to think through how, under something called the anti-fraud provisions of the Securities and Exchange Act, or 10B, for those lawyers, how to build upon that. And a lot of the insider trading cases from the 70s and 80s and the like, the important key cases, were built not by rulemaking, but by enforcement, and built a body of law between the commission, following the facts and the law, and courts all the way up to the Supreme Court. So this is an important thing that has been true for decades. And if you're seeing that in some places we do that here as well, they complement each other. Examination, enforcement, policymaking, market oversight, all complement each other.
It's a fascinating example, Chair. I think insider trading is an area where people have begged at times for a rule rather than something that's set out through actions by the enforcement staff and orders that are handed down from the bench. It seems like you're leaning into that a little bit to say
no,
that.
I'm just saying, I think it's a mix. With all respect, I mean, we're leaning into protecting the American public. That's what we're leaning into. But there's these various tools, market oversight. The staff themselves, with delegated authority, review tens of thousands of filings a year. So it's also there. You build trust on how corporation finance and investment management reviews filings. We get probably hundreds, if not thousands, of requests for all sorts of other guidance, maybe measured in the multiple thousands. It's a big agency. Yeah. And so how we engage and we give feedback, and some of that feedback then leads to rulemaking.
Yeah, no, that makes sense. And, thank you for sort of building on your earlier answer. I think it's really helpful, and, is the role of the commission to spot these gaps, which I think we're going to talk a little bit about in a minute. We want to hit on at least a couple hot topics before we let you go. As you mentioned, crypto has to be among them. I think, the issue is this: the crypto market itself, as a technology matter, seems to be evolving constantly and quickly. But the regulatory landscape, at least lately,
I don't know if I agree with your premise. The underlying this all is Satoshi Nakamoto's ledger technology, an 8-page white paper published on Halloween night in 2008, in the middle of the financial crisis, and on a cypherpunk mailing list. You have to understand where this was. And the clever, really innovative approach to the Byzantine thought problem, like, what happens if multiple adversarial players that don't trust each other, we were talking about trust, what if they're trying to share a ledger, a system of records, and confirm the system of records? And that technology is there, but that's how to record records. That which has been built on top of it, again, without prejudging, largely has been these financial products, these tokens that have raised money from the public and have become speculative, investable assets. And a lot of what's happened there looks a lot like traditional finance. It's tended towards central intermediaries, highly centralized intermediaries in some cases that have large market share, but they're not necessarily following the current laws. And I'm not just talking about securities laws. I'm talking about like Bank Secrecy Act and protecting against anti-money laundering and like. I'm talking about, I was honored to be chair of another agency, another great agency, the Commodity Futures Trading Commission. They're not all necessarily complying with the Commodities Exchange Act or the securities law where and if they have trading of crypto security tokens. So I'm sorry, Kurt, I'm just saying it's a field with an awful lot of non-compliance. And people have gotten really hurt. I mean, they have. And I'm talking about hurt in the terms of billions and tens of billions of dollars.
So I think in the middle there, you said something that kind of gets at the question that I have for you, which is you said it sort of looks like, I'll just say TradFi in some senses, right? But people aren't quite sure what to do with different tools or services available in the crypto markets. And that's why I think we see
comply with the law. That's what I would say. You're not going to build trust. This field will not sustain itself. I really don't think so. Look, I mean, there's 15 to 20,000 tokens, so that each of them have to sort of have a real value proposition. I used to teach this up at MIT, and I'd press the students, what's the value proposition of this token or that token? They're not providing the disclosures that traditional venture firms, would request. A venture firm would request various disclosures if it's private, and then they're certainly not providing the disclosures that public issuers provide. What's the value proposition? What's the financial outlook look like, et cetera, And yet there is a management team. There's somebody paying the lawyers that are listening to this. I ask anyone listening to think, if you've got a crypto client, do you have an engagement letter? Are they paying you a fee? Well, did you negotiate that with somebody, or were you negotiating with a decentralized blockchain? I doubt it. Kurt, Chris, if you have any crypto clients, your compliance folks at your law firms wouldn't let you take the client unless, you actually had some human you signed one with. Now, maybe in the future, it will be some AI, but you're still going to make that AI model sign something.
I mean, with AI, you're leaning into the next question. We haven't gotten to the crypto one yet. So here it is.
What do you want?
Oh, here it is. So look, it's just, there's a lot happening on the Hill. That's the gist. It was a longer question, but it seems to be some genuine efforts to even reach across the aisle right now to craft some kind of crypto legislation that would create boundaries or barriers, right? And sort of delegate to this agency
Kurt,
certain parts.
Are you familiar with I'm going to go to another field of medicine, the Hippocratic Oath?
Yes.
Like, first rule is do no harm.
Absolutely.
We got $110 trillion capital markets, deepest, most liquid in the world. And it's based on having these securities laws and having cops on the beat or referees on the field. If we didn't have the securities laws, it would break down pretty quickly.
Yeah.
All right. Do no harm. And so while there are efforts to possibly bolster some of the authorities, for instance, or over at the CFTC, an agency I quite admire and feel proud to have been a part of. Let's not do any harm in this $110 trillion capital markets. And these 15 or 20,000 tokens, without prejudging any one of them, many of them meet the law of the land called the Howey test. And I note this. It's like this Howey test, the Supreme Court articulated what is a security, or more particularly, what's an investment contract. And it's gone up to the Supreme Court over and over again, reaffirmed as recently, I think, as 2019. But even if it hadn't been reaffirmed, it's the law of the land. And there are thousands, maybe tens of thousands of times lower courts have referenced the Howey test. We ourselves at the SEC have spoken to the public through at least nearly a couple hundred orders or settlements. And we've had really key cases in various circuits now around this. I think your listeners, the lawyers, they know what this is. And many are, I would say, a vast number of these tokens are operating in schemes that are investment contracts and ought to come in under and comply with the securities laws. That's the core. And you don't want to do any harm to the securities markets.
Chair, leaving the world of crypto for a second and moving into another kind of buzzword, maybe this is the 2024 version of what we all talked about in 2018. AI, artificial intelligence, is something that is across the market and the news spectrum being discussed. And recently, throughout 2024, and as recently as this week, the commission has brought enforcement actions against businesses, entities, and individuals alleging AI washing, right, as a term of art. They're utilizing the idea of artificial intelligence capabilities or participation in that world to bring investor money in or to start a business that maybe doesn't fit. And we kind of almost liken this recently to matters of enforcement from the commission as it relates to ESG, maybe 2 or 3 years ago, and adding those acronyms or those governance ideas to your business, making a change. I mean, should we really be as worried about AI washing as maybe you all have signaled, or where is the SEC on that monitoring of AI as itself versus the disclosures therein?
Great set of questions. Just a little short history. When I went to MIT back in late 2017, and I was asked to get involved in the intersection of finance and technology, what better place to do it? Another thing that I'm just so I got to pinch myself that they actually asked me to come to MIT. Really? And I was like my identical twin brother, Rob, and I were kind of math geeks as kids, but here I was being asked to come back. And I said, well, great, but I want to get involved in AI. This is the fall, winter of 17. And sure enough, I did stand up these classes on blockchain, but I also got involved in artificial intelligence and over at the fintech lab over at the college of, I think it was CSAL, which you mentioned earlier, is the AI lab. And I came to believe then, and I still believe now, this is the most consequential technological shift. Every bit as big or bigger even than the internet and, the 1920s with the mass electrification of the factory and all those wonderful products. I say that because I think that it's sort of how we're transitioning. And I'm not talking about generative AI. I'm talking about AI that's already started 10 and 20 years ago. But this shift of more and more of what goes on in our biological minds into the computers for predictive data analytics and making decisions and the like. In terms of that types of transformation, it's going to have a lot of really good things for finance and for the capital markets, but it's also got things we've got to look out for. You mentioned one micro area. I call it micro because there's also some financial stability macro issues. But one area is, there's old saying you should say what you do and do what you say. That's kind of the core of the Rooseveltian thing. We saw in the late 90s with the internet that it led to an internet bubble, and people were bragging about things they weren't necessarily doing, drawing a lot of investors into that capital market. So AI washing, or what we have an eye out at the SEC, is that investment advisors, broker-dealers, and I'll call them public companies or issuers, if they're talking about how they use artificial intelligence, to be accurate about it. Don't mislead the public. And that's the core there. I would say a second micro area about artificial intelligence is to remember fraud is fraud. And so even if you're using a model, artificial intelligence, some model, that you've got to put your mind into it, making sure you don't manipulate a market, front run a market, deceive a market. And you can't kind of just say, hey, the algorithm did it, go sue the algorithm. Like, Richard Breeden was at our 90th birthday celebration last week. And Richard said, I can't wait until they put an AI model in the slammer. But I still think there are humans associated with that, and those humans have, I believe, affirmative obligations to think through the guardrails to make sure that that model doesn't hallucinate over into manipulating or hallucinate over into deception and so forth. So these micro issues, there's a third micro, and I don't mean this isn't, it's a big issue, is conflicts. Are you using the algorithm to put the investment advisor, broker dealer ahead of their customer issuer? And we put out a proposal on that. We're now considering, based on the feedback, whether to revise it and seek further public comment. But to really, those are big three issues around AI washing, fraud, and deception, and thirdly, conflicts. And I've spoken publicly about that. I think that some financial crisis of the future, we're all going to look back and say, aha, in the middle of it, we were all relying, or too many consequential parts of the market were relying on a central model. And Secretary Yellen spoke about this eloquently a couple of weeks ago as well. I think that look at the centrality of the cloud providers, and nearly 3/4 of finance are relying on two cloud providers, and one of them is really dominant. And so it's likely we're going to have centrality and network interconnectedness and a future financial crisis. And this is not an easy thing to solve for and to protect against. So those are my thoughts on AI, but really transformative. A field that, back to my MIT days, there was more buzz about the crypto and the students, particularly at MIT, a lot of them trading and investing and thinking about crypto. But I always try to say, what's the value proposition to the students? I mean, speculative investing, okay.
Yeah.
Kind of trying to use something to run around or sidestep the protections in anti-money laundering. So speculative investing, illicit activity, it's kind of the leading token to be used for ransomware. But real broad public value proposition, I think artificial intelligence is changing a lot of what we do.
I know, Chair, we could probably spend another 7, 8, 9 hours talking about AI and a lot of the other things at the Commission. We want to thank you for taking an hour with us today to come on the inSecurities podcast. We take your notes on the name. Maybe, Kurt, there's the chance for rebranding.
You name whatever you want. I mean, make sure that if you're started a fund, that you follow the naming rules that we finalized. That 80% of your investments would be with regard to whatever your name. Look, I thank you for having the time, having me on. It's a great agency. It's really, and it's a huge honor to be. And I think every day, it's just, I go back to this. I think, one, it's a privilege. So it's a privilege that I ought to use on behalf of the American public. Those are the people that I think about every day, and making sure that investors and issuers come first, not second, to the market intermediaries in the middle, and that we use the age-old tools of disclosure and protecting against fraud and manipulation and the like to help them have a better future, have the American public have a better future. And we can sometimes put in place really effective rules, also help the U.S. capital market stay the leader in the world, because we can't take anything for granted, and other nation states want to chip away at our leadership. And you can't kind of just rest on the laurels, because, well, we know competition would take away our leadership. So thank you.
Thank you. A perfect note to end the show.
All right.
Thanks for joining us for this episode of the inSecurities podcast. And a special thanks to our guest, Chair Gary Gensler of the U.S. Securities and Exchange Commission. We always love to hear from our listeners. Look for us on social media to share your thoughts and comments or topics you'd like us to explore on future episodes of inSecurities. Please use the hashtag inSecuritiesPod on X or LinkedIn to join the conversation. You can find me at EcomoffCPA and Kurt at Enforce_update. Don't forget to subscribe, rate, and review inSecurities wherever you listen. Be well, everyone, and we'll see you next time. Thanks for tuning in.
Thanks for listening to inSecurities, a podcast from PLI, the Practicing Law Institute. PLI is a nonprofit provider of authoritative professional services training and continuing education. In an increasingly complex business environment where intricate corporate structures reign, inSecurities can help you make sense of it all. A special thanks goes to the producer of inSecurities, Daniel Peinitz, as well as hosts Chris Ekemoff and Kurt Wolf. For more information about PLI's SEC Institute, or to view hundreds of hours of fresh and relevant on-demand programming covering changes within the securities sector, visit pli.edu/membership and sign up for a privileged membership. These recorded materials are designed for educational purposes only. This podcast does not constitute legal, audit, tax, consulting, business, financial, investment, or other professional advice, and it does not create an attorney-client relationship. Please consult a qualified professional advisor before taking any action based on the information herein. Furthermore, the views and opinions expressed in this podcast are solely those of the individual participants. These views are not the views of the hosts or their employers. Users of this podcast may save and use the podcast only for personal or other non-commercial educational purposes. No other use, including without limitation, reproduction, retransmission, or editing of this podcast may be made without the prior written permission from PLI.